The year was 2021. The stock market was booming, our favourite growth stocks only knew what gains looked like, and looking at our investment portfolios became a regular routine to satisfy our desires for making money. But roll on 2022 and disaster strikes. Inflation as high as Snoop Dogg and the US stock market crashing over 20%. Growth stocks are even worse, and now instead of looking at our investment portfolios and feeling happy, now we're looking at our investment portfolios with dread, fear and anxiety. But fear not, because if you are feeling like this, well, be sure to stay tuned, because I'm going to share with you guys some of the advice that I give to myself, which should just give you a whole new perspective on these less than ideal market conditions. But before we dive into all of that, guys, my name's Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below, as well drop a like on the video, guys. Really helps out the channel. With that being said, let's begin. So stick with me on this one, but the stock market is just like a Formula One race. And I don't mean that from the perspective that you're just one small move away from an almighty crash, although that does happen more often than not. But instead, it's more so the point that you can't win an F1 race on lap 1. And more so the point that F1 drivers take calculated risks throughout the course of a race distance in order to make sure that they're there at the end of the race to give them a shot of winning. Because if you think about lap 1 of an F1 race, it can very much be chaotic. You've got cars flying off the grid as soon as it's
lights out and away we go.
You've got cars overtaking and changing positions, and you simply don't know who's going to be leading at the end of the first lap. However, after a few laps, things start to settle down and the race begins to stabilise. It's almost just like starting out an investment portfolio, where the first couple of days, weeks, months, perhaps even the first couple of years could very much be volatile, because from one day to the next, we simply don't know whether the stock market is going to move up or whether it's going to move down. But we all know that in order to get a positive return on investment in the stock market, not only do we need to be taking calculated risks, just like F1 drivers, but we also need to be thinking about year 1, year 5, year 12, year 15. Almost like F1 drivers not only need to think about lap 1, but they also need to think about the future laps within the race too. Now, the reason why I say that is because the longer that you can invest into the stock market, the probability of you seeing positive returns massively increase over time. There was a study once completed that looked at mid-cap global equities as well as large-cap global equities, and that study between 1971 and 2021 concluded just that. Let me share with you guys the numbers. If you'd chosen to invest into the stock market on any given day, your probability of success was similar to flipping a coin, because your percentage success rate would have been 52.5%. And on a side note, if that is your approach and if you are looking at a very short time period in terms of the investments that you're making, well, you're probably better off going down to the casino. However, for those of you guys who are long-term investors, which I'm sure probably all of you are, this is where the numbers get interesting. Because if you'd invested for just one whole year, your probability of seeing a positive return on investment would jump to 72.7%. For 5 years, it would be 88%, and for 10 whole years, you would have a 94.15% chance of a positive return on investment. If you take that to 20 years, then historically speaking, you have nearly or as close to a 100% probability of actually seeing positive gains on your portfolio. Pretty much a 100% chance, as close to an absolute guarantee that just by holding your investments for a 20-year period guarantees that you make money. Now, whilst I obviously must say that historical performance isn't always indicative of future results, in my mind it makes me pretty damn confident to know that if I just simply invest and hold my investment portfolio for a long duration of time, then the odds will certainly be stacked in my favour. And in fairness, that's all I really care about. Because having that kind of perspective certainly gives me a mental edge within the stock market. Because it's certainly got me to a position where I don't feel the need to panic or even lose sleep at night, let alone sell any of my positions based on kind of adverse market conditions. And the way to get to this point is to think about the stock market like one big research paper. And in this case, let's say the research paper is on UK politicians, which we all know is a contentious topic, especially if you are into your UK politics as of right now.
Friends who are aristocrats, I have friends who are upper class, I have friends who are, working class, but I'm not working class.
Now let's say that you go out to millions and millions of people and you ask their opinion on who they believe should be the next Prime Minister. Now if you did that same research paper back in 2019, well clearly at the time the people's opinions were that Boris Johnson was the best man for the job. But then 3 years later in 2022, if you did the same poll now, would you still get the same result? You can certainly leave your thoughts down in the comment section below to debate over, but I think the overriding consensus is that as of right now, thanks to things like Partygate, the Boris Johnson stock isn't exactly bullish.
You should not be meeting friends. If your friends ask you to meet, you should say no.
And it just so has it that Boris has recently stepped down and inevitably someone else will step in to start a new cycle of UK politics, with a new agenda, new policies and new pledges. Now why exactly is UK politics relevant to the stock market? Well, what I'm trying to capture is that the stock market is simply based on the opinions of the people that invest into it, and those opinions can sometimes change as well as be volatile too, because the sentiment of people who invest into the stock market can certainly change over time. One year they might be bullish, and then things might change in the broader macroeconomic environment like rising levels of inflation, and then all of a sudden the next year they're bearish. This is what we call market cycles, where the sentiment of investors changes over time. And as of right now, the broader sentiment amongst investors is actually well into the extreme fear territory, which is one of the reasons why the stock market continues to sell off this year. Now going back to UK politics for a minute, I think everybody kind of came to the same general consensus that Boris has been a little bit of a over the course of the past 12 months, and as a result everybody kind of predicted that it was kind of inevitable that he would have to step down.
I have concluded that person cannot be me.
Whereas what I'm going to call as the collective market mind, i.e. the opinion of the people that make up the stock market, perhaps is slightly less predictable. It's certainly more of an unknown, because it's pretty much impossible to predict the outcomes within the stock market from one year to the next, because things can change so rapidly. In March of 2020, I didn't see any kind of economist or analyst talking about the fact that we could see 9% plus inflation in 2022, especially considering we were all facing lockdowns at the time.
You must stay at home.
And as such, the stock market certainly changes based on the changing factors which we're facing into. And admittedly, the collective market mind is somewhat reactive, but also forward-looking too, because the stock market prices in what it believes will happen, and then retracts back if it's priced in too much risk, or perhaps even falls lower if the risk is worse than everybody thought. It's why when US inflation came out at 9.1% last week, but analysts only forecasted 8.8%, so worse than analysts expected, the stock market actually sold off 0.45%. But if, say, inflation came in at 8% and was lower than expectations, then perhaps the stock market may have gone on to gain some momentum because inflation wasn't as bad as everybody thought it would be. Now, of course, that was obviously based on June CPI data, whereas obviously the stock market is forward-looking. So the chances are it already priced in the risk premium associated with inflation, which is probably why we didn't see so much of a crash that you probably would have expected. Now, the reason why I'm telling you this because nor me or any of you guys have any control whatsoever on the stock market. But if you understand the mechanics of how the stock market works, then that can certainly help you manage your own expectations, as you'll know the reasons why the market moves in the way it does. And look, it's not exactly a bad thing when the stock market goes on to crash. Yes, it certainly might not feel great in the moment, but it is very much an opportunity for those of you guys who are prepared in order to really capitalize. And that's why it's really important for us to actually address your risk to cash position, because the relationship between the risk you have on the table versus the cash you have on hand should certainly be balanced. Now, the reason why I call this point out is because when stock market conditions become a little bit more difficult, those who have taken far too much risk within their investment portfolios, investing into more speculative, higher risk assets, and probably over-leveraged in some way, are usually the ones that end up in trouble. So having a sensible approach to risk is important. Making sure you're well diversified, perhaps investing into a broader index fund, is probably the way to go. And on top of that, you're also going to want to be somewhat prepared with a bit of a cash position to deploy those funds into the market when the best opportunities present themselves. Because if you take calculated risks and deploy cash into the market when the markets are down, then if you take a look at this chart of something like the S&P 500 all you really need to know about is the fact that it goes up in value over time. And all you're being able to do during a market crash is simply to acquire assets for a lower price than what they were before. It'd be like me selling £1,000 to you guys for 800 quid. You would obviously snap my hand off because you would have acquired something that had a higher market value than what you paid for it. The only difference being obviously fiat money devalues over time with inflation, whereas assets on the other hand go up in value over time. So your £800 in fact, if invested into the right assets, could be worth £1,000, £2,000, £3,000 or £5,000 some years into the future. But of course, first you need to be in that position to be able to give me that £800. So make sure that you focus on your financials and your cash position in the background, because as I said, when opportunities present themselves to you, you're going to want to be in a position to take them. So build a 3 to 6 month emergency fund, focus on moderating your risk within your investment portfolio, and if you're able to do this successfully, then you'll be able to manage the volatility of the collective market mind, and therefore go on to capitalize by the time the checkered flag is waved at the end of your investing lifetime. Now if you guys found that video helpful, then be sure to click on this one next, where I explain how Vanguard thinks you should actually invest during a recession. And with that being said, I'll see you over in the next one.